Okay, guys, so what we're going to now have a look at is what creates an exchange rate value, because this is very important. Now that we've looked at which currencies you want to pay attention to, we've understood how central banks set interest rates to control inflation, and they were increasing and decreasing the money supply. And we've looked at how that really has a big effect on a currency's value. And then we've looked at the countries that are greatly affected by either the exports of that country is going up or down in value, or a currency being affected by the interest rate and money supply being set by the nation's central bank. So you're really going to understand how this whole system works. It's really quite exciting once you do understand it, because you're going to understand why currencies are moving up or down in value. What are the factors pushing a currency up and down in value? And then how can we try to position ourselves to know what to look out for in terms of economic data, to get trade ideas, to be on the right side of the markets. So when we do get into the markets and we do use technical analysis, we do use risk management, at least we understand professionally why the markets are moving the way they are. And basically what that means is you're going to be trading alongside hedge fund managers, you're going to be trading alongside the big boys, and you're going to be understanding exactly why they are buying, why they are selling. And when you do make money off it, I can tell you right now, guys, it's been one of the most satisfying feelings you'll have when you can really trade alongside the best in the world and make money out of it. It really does pay off, for an example, when you've gone through these kind of courses and you understand it. So let's look at an exchange rate value. So guys, an exchange rate is derived by taking the total amount of rest of world currency reserves of one nation's currency and comparing that total amount of rest of world reserves to another country's currency, and we compare them as a ratio. So when we say rest of world reserves, now remember, if you have a country like Australia, they are importing money into their country because they're selling goods, services, and financial assets. So money's coming into that country to buy their goods, for an example, like iron ore, which is a massive commodity that gets sold out of Australia to the rest of the world. So countries like China, Japan, for an example, they want Australia's iron ore to build buildings, for an example, and they're obviously going to have to sell their Chinese yuan. They're going to have to sell their Japanese yen in exchange to buy the Australian dollar to purchase the Australian key exports that help the rest of the world. And that's a credit coming into the Australian economy, because they're selling basically really important goods that people need around the world. If they're selling services, then that could be anything from, I don't know, financial services, for an example. And again, money has to come into their country to pay for the services that they're providing to the rest of the world. And then, of course, if people want to buy Australian stocks for companies, or they want to buy bonds that are being sold by the Australian government, then obviously that's a financial asset that has to be purchased in Australian dollars. So again, money's coming into the country to pay for something that's in demand being sold out of Australia. So it's a capital inflow, and this is seen as a credit into their country. Now remember, when money's coming into Australia, then that means there's less rest of world reserves of Australian dollars in circulation, because they're being sent into the economy, into the country of Australia, to pay for their exports. On the flip side, obviously Australia will import some goods and services as well. So they're buying goods from China, for an example, they're buying a service from Japan, or they're buying, or people in Australia are buying stops in China or stops in Japan. They're going to have to sell their Australian dollars in exchange to buy other currencies in order to purchase their goods, services, or financial assets in another country. So that is a money outflow that's seen as a debit out of the country. So you got money coming into the country to pay for their goods, and you got money coming out of their country to pay for their for other people's goods and services. And then left over, you have a balance. So you have a balance of more money either coming in or more money going out, and that balance of more money coming in or more money going out is basically going to be giving the rest of world reserves of Australian dollars are going to be increasing or decreasing. So, for an example, if Australia is selling more goods and services to the rest of the world than they are importing, then their rest of world currency reserves are decreasing, because more money is coming into Australia to pay for their goods, services, and financial assets, compared to more money going out of Australia to pay the rest of the world for their goods and services and financial assets. So basically, the rest of the world is sending more money to Australia than Australia is sending to the rest of the world, and that is decreasing the rest of the world reserves of Australian dollars. And again, on the flip side, if Australia was buying more goods for the rest of the world than they're selling, then that is going to increase rest of world reserves of Australian dollars. So what we want to be doing to look at an exchange rate and understand what gives the value of an exchange rate is what you're doing is you're looking at one country's rest of world reserves compared to another country's rest of world reserves, and then you compare those rest of world reserves as a ratio, and that ratio is what the ratio is what derives an exchange rate. That is what the value of an exchange rate is based on, which country has more rest of world reserves compared to another country, and then what's happening is that rest of world reserves increasing or decreasing, because that's going to have a big impact on the exchange rate. So as an example of this, if you're looking at the Aussie dollar against the US dollar, the ratio of how many US dollars you get in exchange for one Australian dollar is what creates the exchange rate price between the two countries. So we take the total amount of US dollar rest of world reserves and the total amount of Australian dollar rest of world reserves, and we compare them as a ratio to get the exchange rate. So the ratio that the market is prepared to exchange Australian rest of world reserves into US rest of world reserves is what creates the Aussie dollar US dollar exchange rate. So if Australia's rest of world reserves are decreasing, that basically means that it takes less Australian dollars to buy US dollars based on rest of world reserves compared as a ratio. And that basically means that the Australian dollar can go up in value. So, for an example, let's say Australia's commodity, their key commodity, iron ore, let's say that goes up in value dramatically, then obviously a lot more money is coming into their country to pay for their key commodity that's going up in value, and that could decrease rest of world reserves of Aussie dollars. But if, for an example, the United States is not selling any commodities, then their rest of world reserves is kind of staying at a predictable rate until, for an example, the central bank does something that makes either the currency become very attractive or less attractive. And that basically means is that when you're looking at the currency exchange rate, we need to always just be understanding what would create the demand for a currency to going up in value or going down in value. And basically, if it's going down in value, then that basically means more money is coming out the economy than money coming in. And when it's going up in value, more money is coming into that country compared to much money going out. And when we're comparing the two as a ratio, that's what's driving the exchange rate higher and lower. So that is why I was talking about the commodity currencies. We have to understand, okay, so which countries are having commodity exports that are making a large proportion of their exports to the rest of the world, because that's going to have a big impact on the rest of the world currency reserves. If their commodity price drops dramatically, then that's basically can be driven by two factors. Either their demand is dropping dramatically, which means less money is coming into their country, and if imports are staying the same, then that basically means Australia's rest of world reserves will be going up, and there'll be more rest of world reserves increasing. However, if the commodity is going up in value, then that basically these more money is coming into the country, and the rest of world reserves of Australia are going lower. And this is why, as I'm going to show you guys later on, when you start to look at exports going up in value or down in value, you literally see the currency start to strengthen because it's increasing the money coming into the country, and the rest of world reserves are decreasing. And that's basically meaning that when you're comparing Aussie dollars to US dollars, for an example, in an exchange rate, the ratio when you're comparing those rest of world reserves are going in favor of the Aussie dollar because their commodity is going up in value, their key commodity, for example. And then again, as I was saying, for countries that don't export any commodities, it's all going to be driven by interest rates by the central bank, because that, as I will touch on later, is going to drive the value of currencies a lot in the market. So let me just show you guys, for an example, how a commodity going up in value can really increase the amount of money coming into a country, because they're exporting more goods for the rest of they're exporting their commodity to the rest of the world that is now going up in price because of the demand going higher. So more money is coming into that country, and that basically means the rest of all reserves of that country's currency is decreasing and causing it to be able to buy more of another country's currency, like, for an example, the US dollar when you're looking at Aussie dollar, US dollar. So let's have a look at this example here. I'm going to give you a perfect example of Australia's currency and their key commodity export, iron ore. So highlighted in red, we have the iron ore price, and highlighted in green, we have the Aussie dollar, US dollar going back from 2006. So what can we see here? We can see the commodity price of iron ore going up in value because the demand for Australian dollars the demand for their key export iron ore is going higher, and basically more money is coming into Australia to buy iron ore, and that basically means that rest of world reserves of Australian dollars are decreasing. And then when you're comparing them against the US dollar, rest of world reserves as a ratio, it's moving in favor of the Australian dollar. So you can clearly see here, this is why the Aussie dollar goes up in value against the US dollar. But soon as the commodity export starts to drop in value, then that means that less money is coming into Australia to buy that commodity export. And if Australia is still buying the same amount of imports from the rest of the world, then that basically means that the rest of all reserves of Australian dollars is now increasing, not decreasing. And that's why the Aussie dollar compared to the US dollar rest of world reserves now moves in favor of the US dollar, and that's why the US dollar then strengthens against the Australian dollar. And that is why when you look at this, they literally move hand in hand with each other. You're now seeing in real time exactly what I'm talking about. You're seeing how rest of world reserves of one country compared to another country can be greatly affected just by the commodity price, because that's going to have a big impact on how much money is coming into a country or how much money is going out of a country. And then obviously when you're comparing two countries' rest of world reserves as a ratio, it's going to have a big impact on the exchange rate value. And that is why, guys, you can see they literally move hand in hand with each other. And this is why we have to understand what's happening with commodity prices to understand how to trade commodity currencies and get really good trading opportunities in the markets. I can also show you for an example over here, the Aussie dollar against the Japanese yen. And again, when looking at the iron ore price, you can clearly see again, they literally move hand in hand with each other. You have the iron ore price in blue, you have the Aussie dollar Japanese yen, the highlighted in orange, and look again, guys, they're literally moving along with each other, and it's having a big impact on the exchange rate. Now, let's have a look at the currencies that sell oil, for an example. So let's look at the commodity currencies. So if you look at the oil price, so Canada, their main export was oil. So when we're looking at the US dollar, Canadian dollar, we are looking at the US dollar as the base currency. So if the exchange rate is going up in value, then the US dollar is getting stronger against the Canadian dollar. And if the exchange rate is going down in value, then the Canadian dollar is getting stronger against the US dollar. So what do we see? We have oil priced here in the orange, and there was $140 a barrel. So as the oil price is dropping dramatically between 2001 and 2007, from $140 a barrel down to $40 a barrel, look what happened. The US dollar really strengthens against the Canadian dollar. But why is that? Just as we just spoke on looking at the Aussie dollar, it's exactly the same for the Canadian dollar. As the oil price is dropping, this basically means that now there's less money coming into Canada. But if Canada's still importing the same amount of goods as they were, then this means that rest of world reserves of Canadian dollars are increasing. And then when you're comparing them to the US rest of world reserves, it basically means that the US dollar is getting stronger against the Canadian dollar. And as soon as the oil price stops to rise, there's no surprise that the Canadian dollar now strengthens against the US dollar, because now there's more money coming into Canada. So rest of world Canadian dollar reserves are decreasing. And if the US rest of world reserves are staying the same, now it takes more US dollars to buy a Canadian dollar. So that's why you could see, guys, there's a really good relationship between the two, where you see oil prices dropping, and no surprise that US dollar does not to strengthen. And then as soon as the oil price starts to rise, no surprise the Canadian dollar now starts to strengthen. For an example, I'm sorry, looking at the other way around, apologies. If the oil price starts to rise, the Canadian dollar is getting stronger against the US dollar. And as soon as the oil price starts to decline, the US dollar then starts to strengthen against the Canadian dollar. They literally move in opposite correlation. So that's really important to understand. You can see exactly the same situation here with the Norwegian krona. Norway's key export is oil. It accounts for over 50% of Norway's exports. So again, we're looking at the US dollar as a base currency. So what we see is that oil price goes higher. What happens? The Norwegian krona strengthens against the US dollar, because now there's less rest of world reserves of Norwegian kronas in circulation. And as soon as the oil price starts to drop in value, what happens? The US dollar strengthens now against the Norwegian krona. And as soon as the oil price then starts to rise again, we see the Norwegian krona getting stronger against the US dollar. And as soon as the oil price starts to decline again, the US dollar strengthens against the Norwegian krona. So you can clearly see, guys, exactly the same situation. Now we can look at another commodity, which is platinum. So South Africa sells platinum to the rest of the world. It's their key export of a commodity. And what do we see again? We see as the platinum price is dropping in value, what happens? The US dollar strengthens against the South African rand. Why is that? Because again, as the key export goes down in value, less money is coming into South Africa. So rest of our reserves are increasing as long as South Africa is still importing the same amount. And now it takes less US dollars to buy a South African rand. And as soon as the commodity price stops to rise, which you can clearly see here, now the South African rand starts to strengthen against the US dollar. So again, guys, they literally move in opposite correlations. So it's so important for us to really get this, guys, and really understand just how much commodity prices can impact the currency markets. So that's really cool that you've been able to have a look at that, understand just how much of an impact that this has on the currency markets when looking at commodity prices. Okay, guys, so now we've had a look at how the commodity prices affect the currencies of countries that are exposed to oil, for an example, or iron ore, as we looked at for the Aussie dollar. Now we need to understand what is going to be the key driver for countries' currencies that are not exposed to commodity prices, and it's all about interest rates. Okay, so interest rates have a massive impact on the demand for a country's currency, and inflation / GDP growth are the key drivers for all currencies, because it's inflation which is going to be giving the markets the opportunity to be buying and selling a currency based on their expectations for what a central bank is going to do with interest rates. So as we know, non-commodity countries have a less concentrated exposure to one key export like oil, for an example. So their reservoir reserves are not greatly affected by just the price of one export. Is more to do with direct investment. And what's going to make a country's assets very attractive to investors is interest rates. Because if interest rates go higher, then that could basically mean that investors can get paid more interest if they buy a government bond, if they buy corporate bonds in that country, and also if they trade the currency. So when interest rates are going higher, it attracts a lot of money into the country, and that obviously has a big impact on the value of the currency. And if interest rates are going lower in the country, then that's also going to have a big impact on the demand for a country's currency. So countries that reservoir reserves are not concentrated or exposed on one export, for an example, it's the inflation expectations that's going to be a sign of the strength of an economy and what's happening with the central bank in terms of increasing interest rates or maybe lowering interest rates based on if inflation is going around their target. So as we know, many central banks have an inflation target of around 2%. Some have a higher inflation target. So what we need to do is we need to understand where is inflation now and where is it heading, to understand what's likely to happen with the central bank, so we can get ideas as to why the markets are going to be buying a currency based on the expectations for interest rates. And remember, a central bank sets interest rates to make sure that there's maximum employment. So then people are in the economy spending money, keeping inflation around their target. The economy keeps growing. And basically, when I say growing, it just means businesses are earning profits, because GDP, which is the value of everything being produced inside of an economy, is just the value of everything being produced by businesses. So as long as you make sure that people all have a job, then there's always going to be someone spending money. There's always going to be a demand for goods and services. Businesses are always going to be making profits, hiring people, and that basically helps the citizens of a country remain prosperous in that kind of economic backdrop. So now we need to understand is the interest rate set by a nation's central bank sets the rate of interest paid or received when using a nation's currency to buy another country's currency. So let's have an example. Let's look at the euro against the US dollar. So the euro USD exchange rate is $1.50. So 1 euro buys $1.50. So let's say you take 100,000 euros and you sell those euros in exchange to buy 150,000 US dollars at the exchange rate of $1.50. Now, you are using euros to finance the purchase of US dollars, okay? So when you're taking a trade in the currency markets using your brokerage account, when you are taking that trade, you got to remember that a central bank has an interest rate, and that interest rate is basically meaning you're either going to have to pay interest when you borrow money from in that currency, or if you or if you buy that currency, you're going to be receiving a certain amount of interest. So let's say you go to the bank and you borrow money from a bank, they're going to charge you an interest rate on that money. Or if you put your money into a savings account in a bank, they're going to pay you some interest. And that interest rate set by the central bank is going to be determining how much you have to pay to borrow the currency, or how much you get paid when you invest that currency, for an example, in the savings account. It's exactly the same when you're trading the currency market. So remember, an interest rate is over 365 days, which is 12 months. So let's give an example of what we just said. Let's say you took 100,000 euros and you bought 150,000 US dollars in exchange. If the interest rate in Europe is 0%, then that means that if you borrow the euro to buy the US dollar, because remember, you have to own euros first, sell your euros in exchange to buy US dollars, you're going to pay in your trading account 0% interest on the euros that you're borrowing to finance the purchase of the US dollar, because the European Central Bank's interest rate is 0% over 365 days. So you don't have to pay any interest to borrow that economic region's currency. Obviously, the reason you'd have interest rates at 0% is because, let's say, inflation is too low, so they basically cut interest rates to zero to say to people, look, it's easy to borrow money. You can go borrow money to buy a car. You can borrow money to buy a house at really low rates of interest. You can go in and get a student loan. You can do all sorts of stuff at low rates of interest, and that basically just creates an environment where people can borrow, spend, and try to get inflation up to their target, help people get into work, as I was explaining. Now, on the flip side, let's say the interest rate in the United States is 2%. Why would it be 2%? Well, maybe the US doesn't have an inflation problem. Maybe inflation is around their 2% target. And in the past, they've had to raise interest rates to keep it at 2% because their economy is very strong at the moment. And maybe they have more people employed in Europe. And there's a lot of demand for goods or services. So they have an interest rate around 2% to maintain inflation around their target. Okay, so that basically means that if we're borrowing euros to buy US dollars, as I said, the lending rate on borrowing euros is 0, but the deposit rate on investing in US dollars is 2%. So we get paid 2% interest on the $150,000 that we've bought for US dollars, and we're paying out no interest on the euros that we borrowed in order to finance the purchase of US dollars. So what does that basically means? That means that if I held this trade for 365 days for 1 year, I would get paid $3,000 profit on my US dollars over that period. Because remember, I bought $150,000. 3% of that is equal to $3,000. So you now sell your $153,000 back into euros at the exchange rate price of 150 and say 12 months, 365 days, and now your $100,000 that exchange rate price is buying you back 102,000 euros. So you basically made a 2,000 euros profit just because the interest rate in the United States is higher than the interest rate in Europe. So now you've started to understand that when countries have a higher interest rate against another country, that attracts money for one country into another country. Or in the Forex market, investors look at that opportunity and say, oh, okay, even if the exchange rate doesn't move in 12 months, even if it stayed exactly the same at $1.50, because I get paid 2% interest on those US dollars that I purchased, I'm going to make a profit over 365 days. So I'm making $3,000 profit on those $150,000 I bought. If I'm getting paid 2% interest on those $150,000, I'm going to get paid $3,000, over 12 months. And when I take that $150,000 and I set it back into euros, even if exchange rate is exactly the same, I'm now going to get more euros than I started off with. And that's how you make money in the markets. That's why interest rates are so important to investors, because it's the opportunity to earn interest off of the differential in interest rates. And that's why, for an example, if interest rates in one country goes up, you will start to see a lot of money flood into that currency, and as well as getting a higher interest rate compared to the funding currency that you're using, the currency may go up like 15% in value. So you can make 15% on the currency that you've purchased and make the 2% interest over 365 days. So you may end up making 17% interest, for an example, on that trade. And then when you set it back into the other currency which you started with, you made a nice profit in the markets. So the most important fundamental factor to focus on when trading non-commodity currencies and commodity currencies, but especially non-commodity currencies, is what is happening with inflation, what are the expectations for inflation, so what's going to happen with interest rates, because we know if inflation is going too high, central banks are going to act by increasing interest rates to slow down inflation. That's going to make the country's currency attractive. Or, for an example, is the central bank going to be lowering interest rates because inflation is too low? Because that's going to make a currency unattractive, because you're going to pay less interest when you purchase that currency. So then that doesn't mean the demand for that currency is going to be higher than it previously was if the interest rate was higher before, for an example. So high inflation is because you've got a strong economy, a lot of people are working, inflation is rising, and then the currency will get stronger because investors can buy the currency now and profit from the appreciation in the currency's value. As I said, as money goes into the currency due to an increase in demand because investors are chasing the higher interest rate alongside profiting from the higher interest rate differential if you use a currency with a lower interest rate. So when we're trading the markets, we're always trying to look at the opportunity of using one country's currency, like the euro example here, where interest rates are very, very low, and we want to be buying another country with a higher interest rate than Europe. And as long as the currency we're buying has a higher interest rate, we're never going to lose money in that trade unless the currency that we're using to fund that trade starts to go up in value. But what you're going to see is that currency going up in value with a lower interest rate is only going to be because something's happening inside of either the country that has a low interest rate. Maybe the inflation rate is starting to rise now, so maybe the expectations for that country's currency will start to strengthen because interest rate changes may change the differential in interest rates. So it's all important to look at the interest rate differential and inflation expectations. Here I'll give you a prime example of the interest rate differential and how it affects the currency market. So we have the Aussie dollar, US dollar here, as we can clearly see. We also have the exchange rate value. Sorry, the exchange rate value is in green and the interest rate differential is in yellow. So what we can see is when interest rates in Australia, because it's the base currency compared to the US, when interest rates are going higher in Australia relative to the US, so the differential is going higher from, let's say, 0.5% all the way up to 4%. Look how strong the Aussie dollar against the US dollar. Why? Because investors are chasing this opportunity to earn a nice, handsome profit over a long period of time, whilst the expectations for higher interest rates are going higher in Australia's favor. When the interest rate differential starts to narrow and go in favor of, it could still be in favor of the Aussie having a higher interest rate than the United States, but it may not be as positive or as profitable as before. So like I was saying in the previous video when we were looking at exchange rates, profiting from a trade, as soon as markets realize, oh, maybe the US is now starting to raise interest rates and the Australian central bank is not going to raise interest rates anymore, or let's say for whatever reason, somehow now the Australian central bank is looking to cut interest rates because maybe growth is starting to slow and inflation is dropping. Now investors are going to quickly close those trades at the best available price, like I showed you in Making Money from Exchange Rate this video, because now they're trying to get out of the trade because the interest rate differential may not be as profitable as it was previously, and that's where they closely follow each other. So what you can see here is, let's say we have a dollar amount of differential when we're buying or selling the exchange rate. So what we can see here is, as the exchange rate value as the interest rate differential is going in favor of the Aussie interest rate over the United States, you could see that you could be earning, for an example, if you're taking 100,000 units position, which I'll explain in a bit more detail later, but you could be earning $2 a day interest when you're taking that trade. But what if that goes up to $4 a day, $6 a day, $8 a day, $10 a day, $12 a day? Because the interest rate differential is going in favor of Australia, it just attracts a lot more money into Australia, and hence why you see, for an example, when the interest rate differential is going up, it's just making more money coming into the Aussie dollar against the US dollar if the Australian central bank has a higher interest rate than the United States. If the interest rate starts to narrow, it's still in favor of Australia, but now it's not paying as much as it previously was. So you was owning $12 a day, but now the interest rate differential is going lower and you could now be owning only $6, $4 a day. So now you understand why these investors are going to be cashing in quickly once the interest rate differential narrows, because they're going to be earning less interest per day, and then they're going to be selling the Aussie dollar back into US dollars to profit from that trade at the best available price, as I showed you in the other video, Making Money from Exchange Rate. So the most important factor we have to pay attention to is which way which currency has the higher interest rate, because we don't obviously ever want to be taking a trade in the markets where we're buying one currency against another currency, but the currency we're using to fund a trade it have a high interest rate, because that doesn't make any sense. You're just losing money every single day. If I give an example over here, we can have a look at, for an example, the Russian interest rate compared to the United States. Right now, Russia's interest rate is 6.5%. The US is only 1/4%. So if I borrow US dollars and I buy Russian rubles, I pay 1/4% interest on the dollars I fund to buy the rubles, but I get paid 6.5% interest on the rubles I purchase. So if I hold that trade for a year, I'm getting paid 6.25% interest. That's very profitable for me to sell US dollars and buy Russian rubles. But on the flip side, if I buy the US dollar, I get to Russia ruble, I pay 6.5% interest on the rubles I'm selling in exchange to buy US dollars, but I'm only getting paid 1/4% interest on the dollars I'm purchasing. So I'm losing 6.5%, or sorry, 6.25% over 365 days, and that could work out in terms of losing $18 a day, or you could be getting paid $18 a day. So clearly, if you're a smart investor, you are not going to be buying a currency against another currency where the interest rate on the currency you're buying is lower than the interest rate on the currency you're using to fund that trade, because you're just going to lose money. Smart money does not do that unless there's a fundamental reason behind it. And that could be, for an example, inflation expectations changing, causing the markets to move out of one currency and into another currency, for an example. So now you're really starting to understand, guys, what is really driving, for an example, the currency markets when we're looking at countries that are less exposed to commodity prices, but also commodity currencies obviously are going to be massively impacted on interest rates. But what I want to show you later also is that the commodity price does massively impact the value of a currency anyway, because interest rates may have to quickly be set by the central bank to make sure that their commodity export is not going down in value too much, and that their country, basically, for an example, their export becomes too expensive if the value of the currency is going lower, but the commodity price is remaining high. That can cause all sorts of problems, but we'll touch on that later. So we're looking at currencies with high interest rates, and we're trying to match them up against currency with low interest rates, and we're trying to profit from the currency with a higher interest rate compared to a currency with a low interest rate. And I'm going to show you bond yields later in this course as well, to teach you how bond interest rates, which is basically on the higher end of the yield curve, which I'll be explaining in more detail, that also has a big impact on the market. So we always want to be looking at interest rates. Where are they? What's the level set by the central bank? Which currency has an interest rate higher than another currency? And then we're going to be matching up the low interest rate countries against high interest rate countries and try to profit from the interest rate differential. And it's the expectations for inflation that's going to drive the market's expectations for interest rate changes, and that's going to drive and give us trading opportunities in the market. So that's going to mean money is aggressively coming into a currency or out of a currency, causing it to rise in value or fall in value in an exchange rate. So guys, I hope that makes sense. Thank you for watching this video on exchange rates, inflation, commodity prices, and non-commodity currencies and commodity currencies.